we're going to start talking about the action-packed sector of media and telecom, the ins and outs of the media M&A bonanza. We have Davis Hebert, who's our co-head of high yield, another Charlotte representative for CreditSights and head of telecom and media. We have Hunter Martin, our head of media and cable, who I don't think has been getting much sleep over the past month or so with all the headlines. And Mark Lightner, our head of special situations legal research. So Davis, take it away.
Okay, thanks, Winnie, and thanks for everyone for being here. We have a lot of exciting M&A to talk about here, the ins and outs of the media M&A bonanza. And I'm going to show a couple of slides just to show you how important this has been for total returns in the fixed income space. If you look here, we have the media performers. You can see the two tails there. On the upside, we have Electronic Arts, which skyrocketed after LBO news earlier this year, top performing IG name by far. And then on the other end of the scale, you have Warner Brothers Discovery, who I'm sure we're going to mention on this panel, and the planned spin. So probably a lot of nuances in that total return number. So don't put too much stock in that figure because there's been a lot of index changes and things of that nature. But at any rate, Warner Brothers Discovery's performance has been impacted by M&A for sure. So in fact, investment grade media has been one of the laggards in the investment grade market because of M&A and mainly related to Warner. On the other end, you have high yield media. So high yield media has been by far the top performing sector. And a lot of people who might be, have a novel view of this space would say, how could that be? I thought everyone was cutting the cord and no one was watching TV and, et cetera. But the reality is M&A has been the primary driver for this sector. You can see Scripps, Gray TV, Sinclair, Cox Media have all produced double-digit gains in total returns this year. So that's been driving a lot of just trade upside. Let's go to the media industry landscape and switch to the bidding war for Warner Discovery. You can see here the landscape. This is the sort of the setup for how the video industry is structured. We've seen a lot of consolidation, but the Warner Brothers sale has been the biggest asset that's basically come to market in quite some time. You have the future of the storied Warner Brothers studio that's up for grabs. You have HBO Max, one of the most popular streaming services, up for grabs. Cable networks like CNN and TNT. Hunter, Warner was trading at $8 a share earlier this year. And all of a sudden we're in the midst of this bidding war. Can you take us from point A to point B on how we got to this point?
Sure. Yeah, these Warner assets have been through a lot over the years. I mean, they've had at least 3 terrible deals in the past. They were bought by AOL, AT&T, and I would say this Warner and Discovery combination was not successful, although I guess it'll turn out okay. But in terms of how we got just here where we are with these recent bids, I think the best starting point is go back mid-2022 when Warner Media was spun off from AT&T, merged with Discovery. So those companies at the time, I think the starting share price was around $25. They had $11 billion of combined EBITDA with a plan to get to $14 billion very quickly with $3 billion of synergies. Leverage was around 5 times. Plan was to deleverage to 3 times gross within 2 years. Fast forward 2 years, late 2024, stock, as Davis said, hit a low in like $7 area. I think they ended 2024 with $9 billion of EBITDA, leverage still around 4 times. So clearly this isn't working. So the board management says what do we do? And the plan they came up with was, let's separate into 2 different businesses. We have a declining but very cash generative portfolio of linear cable networks. We think that one needs a certain capital structure. It's probably weighing down the valuation. It's hiding the value of our streaming and studios business, which have better growth prospects, really great IP. And if they're separated from these cable assets, the idea was these could be attractive to a number of other buyers that don't want to buy the entire company, right? Someone like Apple or Netflix, and this was the the right call, as we've seen recently, right? So the plan was to separate them. They did a coercive tender and consents to facilitate that on the debt side mid this past year, and they were going to on the path towards separation in mid 2026. However, Paramount kind of threw a wrench in their plans. So David Ellison, or the Ellison family, took control of Paramount. They made several unsolicited bids at escalating prices to buy the entirety of Warner Brothers Discovery. They repeatedly leaked those bids to the press. So at a certain point, Warner Brothers board was forced to kind of publicly disclose them, said we've got a lot of external interest. We are going to do a strategic review, which led us to this auction for the entire business, or parts of the business.
Thank you for that. And so over the past week, we've seen a lot of fireworks. As when you mentioned, I don't think Hunter slept much with all the different headlines. I've got my my phone here to the left, just in case we miss any headlines on this. Perhaps a tweet or a Truth Social post from our president. So at any rate, you can see here that we're going. The situation at the top is who is going to win this bid for Warner Brothers Discovery. And so we're going to look at this from three different perspectives. So the first topic is going to be the buyer's perspective. Then we're going to look at it from the bondholder's perspective, and then we're going to bring Mark in to talk about the regulator's perspective. So a lot of moving parts here. So let's focus on the buyer's perspective first. I think people were somewhat surprised about Netflix. I think people saw them as kind of a very low likelihood. I think everyone knew Paramount wanted it. Not sure if they could get the cash. But just kind of Cliff's notes on these deals. So last Friday, Warner announced it would sell streaming and studio to Netflix for $83 billion, $27.75 per share. That's a 16 times multiple on next year's EBITDA just for streaming and studios. And then earlier this week, Paramount launched a hostile bid for Warner, including the cable networks, $108 billion EV. $30 per share, 100% cash, 14 times EBITDA. So, Hunter, if you could take us through, because you cover all of the buyers, and by the way, Comcast dropped out. They decided they couldn't compete. But if you could look at those buyers, what do they want to do with this asset? And, why are they involved here?
Sure. So I'll start off with Paramount just because I think that one's easier to explain, right? I think it's pretty clear this is a subscale business. So there's a $30 billion EV business. They're competing with Disney 200 plus, Netflix 400 plus, and then you have these tech guys like Amazon, Google, with YouTube. So they're very small. All their profitability, or the vast majority of their profitability, comes from these linear TV networks, CBS Network, Nickelodeon, et cetera, that are clearly in secular decline. And while they do have like a decent sized streaming business with Paramount Plus and Pluto TV, they're very U.S. centric. And I think it's apparent to most people that they're not really on that same upper tier with those other companies that I've mentioned already. So they know, the Ellison family kind of realizes, and they made this as one of the pillars of their new strategy, is like, we need to build a scaled global profitable streaming service, and we need to do that to offset these declines we have in linear. So that was something that they kind of aspired to do. And it's very hard to do that organically. Like Netflix was successful against all odds. A lot of things had to break their way, but now this is a mature business. It requires a lot of cash. Remember, Netflix was burning billions and billions for several years. So Paramount's kind of started this process organically. They bought these UFC rights, brought back South Park, but it would be a long, expensive slog to do it. And then but you can really accelerate that process by buying Warner Brothers Discovery, right? You're getting HBO, you're getting a really big, a larger film studio and a film library. You have a really great TV library. So with those assets together, they have a much better chance at kind of building this scaled global streaming service to compete with the big players. And they were also interested in the linear one. They're one of the few companies out there interested in these linear networks that Warner Brothers Discovery owned. And the reason there is they said, listen, we know that these are in decline. We have these networks ourselves, but by combining them together, we can at least extract a bunch of cost synergies out of them to get more cash, and we can use this cash to reinvest in our business. And they don't talk about this, but I think they also need that cash to support the debt load that they have and definitely would have as combined. So I think the Paramount one is pretty clear. Now the Netflix one, like as Davis said, like I did not believe that Netflix would be interested. I thought they would kick the tires on Warner Brothers, but I thought ultimately they would walk away. They've been builders versus buyers historically. They've never done a large acquisition. And I think most importantly, like Netflix was doing pretty well on its own, right? Like with the strategy they had, like why mess with success? They built into a 400+ billion enterprise value company, a clear subscriber leader in streaming, $10 billion of free cash flow. It was looking pretty good on its own. So this question, why is Netflix, why did they end up bidding so much? Why did they win this asset? So I'll start with this kind of very negative view that the Ellisons are projecting, but other people in the press and in the financial community are. And they're saying Netflix doesn't really want to buy this. They're saying they're doing this more to just keep a competitor, Paramount, maybe NBC Universal, from kind of scaling up with a great asset. They're going to tie this up, spend 2 years, get blocked by regulators. Yes, they'll have to pay money, but it'll be worth it to kind of keep the competitors down. I do not believe that is their primary reason. I think that is a nice benefit for them if this deal does fall apart, but I do not think that's why they've made this bid that was accepted. I think the reason, and it's what Netflix has articulated, they said, we think basically these Warner Brothers assets are better in our model, and we think our model is better with these assets. So the idea there is like, it's actually amazing when you look at how successful Netflix was when they started with no library, no IP, just virtually nothing, right? And they're saying, we've done that like just with having to go out in the open market, create our own original programming. And we've seen what they've done with content that they've licensed from others. You take a show like Suits that was on USA Network, very low viewership, put it on Netflix, it becomes a global sensation. So think about what would happen if they're able to plug in this incredible Warner Brothers TV library. You have Friends, Big Bang Theory, all that HBO content, Game of Thrones, like to put that into the Netflix machine. Like I just think they can monetize this content better than anyone out there. And I think it will replace a lot of other content they would have to license from others or have to create organically, original programming they'd have to create organically. And when it comes to really getting the value out of the Warner Brothers IP, DC Comics, just things like Game of Thrones, Harry Potter, they can invest more and they can put it in front of more people. So for them, they're saying this actually just strengthens our business. We will get cost synergies by basically using the licensed or the existing content, not having to license externally. We will have a higher hit rate on original shows we make because it's going to be based in great IP. We don't have to come up with Stranger Things, which is great, but they don't have that many of those. So that is why Netflix has argued that they're buying it. They're like, this just makes us a stronger company. We can monetize this, allow us to successfully continue to grow subscribers, offer more value for customers, create more profit.
And normally in an acquisition, it's pretty straightforward, but unfortunately for bondholders, this is far from straightforward. And I can see a lot of negatives on the screen in terms of the impact for Warner Brothers bondholders and Paramount bondholders and Netflix bondholders for that matter. But if you put your shoes in a Warner Brothers WBD bondholders, what outcome would you prefer?
Yeah.
In this case?
So initially, I think it was just hands down, it's clearly you'd rather go to Paramount. And I still think that's the case, but I think it's a lot closer than it used to be. So I'll start off with what's going to happen to Warner Brothers Discovery bondholders if this Netflix deal ultimately closes. So what would happen is Netflix is only buying the Warner Brothers streaming and studio business. So the plan is to spin off Discovery Global, which is WBD's linear portfolio, CNN, TNT, TBS, into a spinco. That should happen by the third quarter of 2026. And our view, they haven't been totally clear on this, but we believe the existing Warner Brothers Discovery bonds will travel with that spinco. So as an investor, as a bondholder, you're going to be left with a business that we think will be around 3 times leveraged. We think it's going to be a business that EBITDA is going to decline at around 10% clip or higher per annum. We think the ratings will probably shake out to, at best, low double B, could even be in the single B area. And ultimately, we don't think that business is going to trade that well, right? It's not something equity investors aren't really clamoring over, super excited to buy a business that's in clear secular decline. So we've always had the view that eventually these linear businesses, the best buyer for them, could be private equity, right? So we think, a couple years down the road, this business could be LBO'd. I'm not quite sure about the bondholder protections you're going to have because these WBD bonds are currently covenant stripped. So we think not a great outcome, but that's kind of that's the baseline. The Paramount outcome, what are we looking at here? So initially, we thought this is clearly a better outcome because, one, we didn't think Paramount would ever pay the price that they've currently bid in their hostile bid and might go up, this $30 per share. We didn't think there would be that much debt involved either. So now when we look at this, if Paramount ends up winning this, we think WBD bondholders will be in a 5.5 times leveraged business. We think that they will probably have to utilize like a charter-like split secured, unsecured structure where you're going to have around $50 billion of new first lien debt coming ahead of you. And we think the existing WBD bonds and Paramount bonds are going to rank junior to that. So from a rating perspective, you're probably going to be in the low BB area. So maybe a little higher in this scenario. I think for investors, like you have this negative technical of the $50 billion of new debt coming, but you at least like that I'm now just not referencing only a declining linear business, right? Like now I have a lot more scale. I have streaming assets, studio assets. I'm part of just a bigger conglomerate that has more chance at EBITDA growth in the future. You can also take some confidence, I guess, in the fact that your main shareholders are very wealthy, right, with the Ellison family and a bunch of sovereign wealth funds. And potentially you might be compensated to give up your rights to a junior lien. So all these together, I think they're pretty close, but I would still kind of put myself into the Paramount camp.
Okay, Paramount by a hair. But yeah, super complicated, and we're putting out a lot of stuff on this, so make sure you're staying up to date with what's on the CreditSights platform, because we have special sits working on it, covenant review. We're all sort of heads down on it. So, Mark, I want to bring you in because who wins the battle is one question. Who wins the war is another question, because ultimately regulators and President Trump need to sign off on this. But let's put President Trump aside for a second. In a typical antitrust review of Warner Brothers Netflix, Warner Brothers Paramount, what would be some of the considerations you would think about? I mean, we've seen a lot of stuff being mentioned in the press about Hollywood, content competition, and then on the Paramount side, it's too much power within the television industry. So, how would you think about this from an pure antitrust perspective, putting politics aside?
Sure. One of the most interesting things is I was listening to Hunter, and he was talking about all of the wonderful benefits from Netflix perspective that this merger could potentially have for them. And I had my regulator hat on thinking, those are all the things as a regulator I'd be really, really worried about. And so regardless of who wins this battle, whether it's Netflix or Paramount, this is going to be subject to what I'll describe as heightened regulatory scrutiny. And so I'll just take a second to discuss how that process works. So both the winning bidder and the target will submit notices to the regulators in this country. And the regulators are the Department of Justice, the Antitrust Division led by Gail Slater, and the Federal Trade Commission led by Andrew Ferguson. And for purposes of this merger, we expect it to be led by the Department of Justice within the main Justice Department. And so those notices will be submitted to the regulators. Typically, in large mergers such as this, the regulators will ask for something called a second request, and that's usually done after approximately 30 days or so. And at that point, the parties basically dump a bunch of information on the government so they can analyze all of the wonderful things that Hunter was talking about. And so 3 things can come out of that process. I'll talk about the things that will come out of it, and then we'll talk about the nuts and bolts of it. First, the regulators can do nothing, and that effectively greenlights the merger and the parties can close after a particular waiting period. I think that that's probably unlikely under either scenario. The second option is that the regulators can reach a settlement with the merging parties. And that settlement is a fancy way of saying they can come up with remedies. And those remedies can either be behavioral or they can be structural remedies to the merger itself in order to alleviate concerns that the government has with respect to potential less lessened competition. Some of the behavioral remedies, and we can speculate what those might be, it would be affirmative and negative covenants, for example, to do certain things, i.e. we'll keep HBO separate for a certain number of years, we won't raise prices for a certain number of years, things like that. So promises that the parties would make in order to get regulatory clearance. That's what we call behavioral remedies. In addition, they can ask for structural remedies. And one of the things that's different about the current administration's approach to antitrust versus the Biden administration's approach to antitrust is they're much more receptive to structural remedies. And when I say structural remedies, I mean divestitures of particular assets in order to overcome an issue about lessened compensation. So those are the remedies that the Department of Justice could reach with the merging parties in this case in order to ameliorate their concerns. And the third is the Department of Justice could simply say, we don't approve of this at all, and we're going to race into court to try and block this merger. And one of the things about merger law in this country is the parties are permitted to close the merger unless the court steps in and prevents them through a judicial process, i.e. the Department of Justice runs into court, they file a complaint alleging that this particular merger is going to lessen competition, and then they have a hearing, what's called a preliminary injunction hearing, where the judge or the court will consider evidence and decide whether to block the actual merger at that point. And at that point, typically parties walk away from a deal because the litigation resulting from that can last a long time. So those are kind of in broad strokes, and I'm simplifying this area of the law very much so for the purposes of this discussion, but those are generally the three options. Okay, so what are the regulators going to look at with respect to this particular set of facts, right? So if we're looking at the Netflix set of facts, one particular issue is they're going to worry about horizontal consolidation amongst streaming services. And of course, as is the case in all antitrust matters, defining the market of what we're dealing with usually is one of the most important considerations. So if we're talking about consolidation among subscription services, right, that's a completely different market on the one hand versus all time spent watching TV on the other hand. So if you're Netflix, you're going to argue to the government, hey, look, if we look at all time spent watching TV, this particular consolidation is actually very minimal. But if you look at just subscription services, right, which is what Paramount has said and what people in Hollywood have said, you're looking at a 30% consolidation, which according to the antitrust guidelines issued by the government, that's a really big no-no. It's a really big red flag. So that's one thing they're going to be focused on. In addition to consolidation amongst subscribers, one of the hallmarks of the Trump administration's antitrust policies, they're really focused on labor, more so than just being good or bad for the consumer. So at least one of the arguments that Hollywood has made, a lot of politicians have made, is that this is going to be bad for the labor markets in Hollywood and within the entertainment industry. So that is something that I think they're going to spend a lot of time on. So flipping over to the Paramount situation, one of the things that we think they're going to be focused on is the consolidation of studios. I believe there's like 5 major studios right now. As a result of this, it will go down to 4. And in addition, as Hunter mentioned, there's a lot of synergies with consolidation amongst linear cable. So that's another area that we think they're going to be focused on. But make no mistake, either bid is going to be subject to a lot of regulatory scrutiny, subject to, of course, the big footnote is what the political sphere is going to come in and play an important card in this. And then I should also note 2 additional things. The European regulators are going to have an important impact here. They have very strong, merger review regimes, both in the European Union as well as the UK under the CMA. So that's going to be really important. And I think another wild card is potential litigation from state attorneys general, like the state of California, for example, may come in, and there have already been private lawsuits seeking to block this merger by subscribers of Netflix, for example. So there's all kinds of litigation and regulatory risk that's coming into focus, but it's definitely going to be a long slog.
And so you mentioned political, and we can't ignore that factor because President Trump said he's going to be personally involved in this approval process. I think people thought Paramount would be a shoo-in, but Netflix is in his ear. Both parties are very confident of regulatory approval. It's one of the things Paramount has been sort of promoting is that we have a better chance of regulatory approval. But then after the 60 Minutes interview with Marjorie Taylor Greene, President Trump said the new Paramount owners are just as bad as the old ones. So There's a lot going on here, and I know it's kind of a not really fair question, but if you were to look at that, Mark, how would politics play a role in this, and who do you think has a better shot at getting this across the resolute desk, if you will?
Well, I'm not sure I have any particular insight into terms of who is going to get the blessing of our leader, but I will say that whoever is chosen, if it comes to that, the federal government will get behind it 100%. One of the interesting things about our antitrust policies right now, both the Department of Justice is completely under the control of the administration, but the Federal Trade Commission, which also has concurrent jurisdiction to prosecute these kinds of cases, is also under the control of the administration. And there was just a case on Monday this week about the president's ability to terminate dissenting voices on the Federal Trade Commission. So I fully expect that whatever decision is made all the way at the top, that the federal government will put their full weight behind it.
Okay. Well, as you can see from our graph here, we think Netflix is kind of a jump ball in terms of it ultimately getting across the finish line. Warner Discovery, we think, has a much higher, Paramount, we think, has a much higher probability. So that's how we see it today. We'll certainly be watching the headlines, but that's just how we see it today. So we have probability of who's going to win, and we have probability of regulatory approval to kind of filter through this process. All right, we're going to move on from Warner. We will take a question at the end if we have time, but we're going to talk about another M&A aspect, which is broadcast television. And broadcast television is local TV. So different from what's going on with Warner, Paramount, et cetera. These are local television stations that affiliate with major networks like ABC, CBS, NBC, and Fox. And there have been two long-standing rules in this industry. When I say long-standing, I mean over the past 75 years. The first is a national ownership cap, where one single broadcaster cannot own stations that reach more than 39% of TV households. And the FCC under Brendan Carr is looking very hard at throwing out this rule completely. And they're refreshing some of the comments on 2018 NPRM. And I think everyone thought like, oh, this is a shoo-in. This is absolutely going to happen. A lot of the players in the industry were saying first half of 26, but CEO of Newsmax, Chris Ruddy, has been in Trump's ear, we think. And President Trump said, I'm not sure if I agree with this move. And because I don't want ABC and NBC to get bigger. So I have two questions on the 39% cap, Mark. The first is, can they have two sets of rules for two different types of parties, or can the FCC just kind of waive anything that might run afoul of those rules?
Yeah, let's talk just for a second how the 39% rule came into place, because I think that helps inform what's going on here. So I think the 39% was raised to 39 from maybe like 36% in the last 20 years or so ago. But so the Telecom Communications Act of 1996 contains the current version of the cap. And in an agreement between Congress and the Bush administration in 2004, Congress enacted a provision in an appropriations bill that year that instructed the FCC to increase that cap to 39% pursuant to its rulemaking authority. So the 39% cap is actually an FCC rule that is part of the SEC's regulatory regime. And one of the interesting things about that legislation and that rule is that it's not subject to every 4 years, the FCC has to reevaluate its ownership rules under this quadrennial reevaluation process. And that 39% rule is not subject to that renewal mechanism. And so there's a legal question about whether the FCC, in fact, has the unilateral authority to rescind that 39% rule, because Congress has instructed, for all intents and purposes, the FCC to maintain that rule. So there's a real interesting legal question about whether the FCC has authority over that, and they're hearing arguments on that very issue. And so to your question, Davis, about whether you can have separate rules for different people, the long and the short of it is the administration has the power pretty much within reason to do whatever it wants until the court says otherwise. And so, if, I mean, somewhat glib about that, but I'm also being somewhat truthful, is that the FCC could, bless a particular merger for one reason and reject another. And it may be a pretext for political reasons like you've identified. And then it's up to a court to make a determination whether that was inappropriate.
Okay. So, we'll be watching that. It's going to be a topic, for the next, 6 to 9 months, what happens to this rule. I'd say the Nexstar-Tegna acquisition or merger, I should say, is really going to force some sort of view because the Nexstar-Tegna merger violates basically all the rules of local and national TV ownership. So the other rule is on local ownership. Historically, you've not been able to own 2 of the top 4 ranked TV stations in a local market. Now, the FCC has been waiving this rule in some select cases, but when you get a Nexstar-Tegna merger, where you're going to be reaching 80% of TV households, and you have markets with more than 30 markets where you have duopolies, the synergies are tremendous. So the opportunity is huge for them. So, Mark, I want to bring you in on the local aspect. Because the FCC is currently reviewing these ownership limits as well. What sort of thoughts do you have on that based on what's the validation for this, why they'd be allowed to?
Yeah, so the 39% rule, as I noted, is not subject to this quadrennial renewal exercise that the FCC has to go through. So every 4 years, they have to reevaluate all of their ownership rules that they promulgate. This particular local rule was re-upped, so to speak, in 2023 under the Biden administration. And a number of broadcasters, local broadcasters, challenged that re-upping of the rule in 2023 pursuant to this every 4-year reevaluation process. And the 8th Circuit Court of Appeals earlier this summer threw out that rule altogether and basically said that the FCC in 2023 under the Biden administration did not have an evidentiary basis for re-upping that particular rule, and they sent the rulemaking back to the FCC. So currently, there is no rule in effect barring the merger of duopolies in local broadcast markets. So there's not actually a rule, and so any proposed merger basically has to be proposed to the FCC, and they make an independent determination of whether or not that's appropriate in their judgment.
Okay. All right. Well, with these 2 rules sort of up in the air, there have been super groups in broadcast TV that have really never been able to have strategic conversations, and now they can. And so everyone is talking to everyone. It has been a huge trade in media. I was in meetings in June last year in New York, or earlier this year, and every hedge fund was long this sector. So for the M&A trade, I don't think any of them had a view on who was going to dance with who, but so they just owned everything. And so let's just kind of catch up on what's happened. I think Nexstar-Tegna was something that, if I'm in Nexstar's shoes, it's an all cash deal. So Tegna doesn't have a stake in this deal. Is CEO Perry Sook, this is his way of just breaking glass. Okay, the FCC's thinking about this and thinking about that. It could get tied up in the courts. How about we force the issue and buy one of the biggest broadcasters in Tegna? And I think what happens with that is going to dictate what happens with all these other players, because I think you have Gray and Sinclair and Scripps and others that are sitting there saying, do we really want to lock ourselves up and then this all just ends up egg on our face? So they're sort of biding their time. We published a broadcast TV M&A 101 piece in June. So this really walks through a lot of our thoughts. And I'll be frank, I think we've gotten a lot right. We didn't see Gray as a seller. We saw them buying some stations here or there that are duopolies. They've done exactly that. It's one of our top picks in the media sector this year because we think they're going to delever. They're going to do it in a very straightforward fashion. We have political revenue coming this year, and they're buying stations where they have duopolies. Like, again, the synergies are tremendous. The buyer's multiple on these stations are 3 times EBITDA. To the seller, they're more like 10, but that's how much cost savings we're talking about ripping out when you look at these duopoly situations. Sinclair, meanwhile, is looking for anybody to dance with. So Sinclair has been trying, they talked to Gray. Gray said no. They're trying a hostile bid for Scripps, which is pretty tough when the Scripps family owns or has control of that business. So Sinclair's trying anything they can do. I think Scripps is kind of put in a position where they can be selective. They've sold some stations at 9 times EBITDA, so that's another one of our outperforms in the sector. And then Cox, which is owned by Apollo, is another sort of portfolio that could trade as well. So we're keeping an eye on all this. We do think Sinclair Scripps is a low probability of happening anytime soon. I think we'll have to see what happens with Nexstar-Tegna to sort of see the next transformative merger. It wouldn't shock me to see Gray and Scripps try and figure something out, because I do think culturally speaking, they're more aligned. I didn't mention the risk that nothing happens, right? Trump has come out and said, I'm not sure if I agree with this rule. Chris Ruddy's been saying he opposes the Nexstar-Tegna merger. What happens if none of this happens, right? How do you want to be positioned? In my opinion, I think Gray is well positioned either way. I think they're going to have a big political year. I think Sinclair would be the one I would avoid, because I think they're more binary. They're a 6 times levered balance sheet, multi-tiered structure, and I think they're going to struggle to find a dance partner. Let's go back to an earlier slide, because we're going to talk about some other M&A. We've spent most of the time talking about Warner Brothers Discovery and broadcast television, but this landscape is all about scale. So I've always kind of said that we're ultimately going to end up in a 5-on-5 basketball game where you have 5 content providers and you're going to have 5 distributors to sort of balance it all out. Seems to be that's where we're headed. We've seen a lot of the content consolidation with Warner's Discovery, broadcast TV I just mentioned. Hunter, what else are you looking for in your coverage universe in terms of M&A?
Yeah. I mean, heading into this next year, I think there's 2 things really to call out. So one is this Electronic Arts deal should close. So I'm pretty excited to look at this new LBO financing, 20+ billion of debt on this video game business that usually do not have any debt. So we published a large initiation on that company earlier this year, and so we're pretty excited to see that debt come to market and kind of follow that situation. The other one is Charter-Cox. So they've announced this deal, but what's going to happen when Charter closes this Cox acquisition? So right now, investors, understandably, sentiment is pretty negative on the cable broadband business, and Charter is basically doubling down on it by buying like the largest private player that was out there. So we want to make sure, we're going to watch to see like how does that execution go? Do they hit the ground running and kind of extract extra synergies, kind of put that Charter playbook to work? And the other thing that we're hoping for could be something that we're watching for this, that it is something that could kind of change the Charter narrative, would be, does bringing in this Cox family and giving them board representation, big owners, does this change Charter from a financial policy perspective? They've already announced a more conservative leverage policy, but do they push? Do they say, hey, let's not do buybacks for a while? Or does this new management, or does this new ownership push for a change in management, which I think would probably be welcomed by the market, given Charter's stock performance, or abysmal stock performance. So those are the ones I'm really excited to watch in the coming year.
Okay. And I mentioned on the distribution side, you mentioned Charter-Cox, and I think the follow-up to that is in telecom cable, you have 3 national providers of broadband: AT&T, Verizon, T-Mobile. T-Mobile is very light in the fixed line infrastructure, but they're buying fiber in some cases. The fourth could be some amalgamation of Charter, Comcast, Cox, and as a 4th national provider of wireless and broadband connectivity. So I think one of the things that I've heard from M&A bankers, what they're pitching to issuers and clients is, if you want to get your M&A deal done, you do it now, because we don't know what's going to happen in the 26 midterms. To Mark's point on the states aspect, so you want to get your deals done now, and so it'll be interesting to see if there's a rush in consolidation in 2026 from that perspective. The other deal we're looking for is DirectTV-Dish. I think the regulatory risk is much lower than it has been in the past. I think that's been well vetted by the market, and it comes down to like Charlie Ergen and control over that asset. A lot of questions we get are like, why does anyone want to own a satellite TV provider? Isn't that like going to zero? The answer is like, probably over time. But if DirectTV-Dish merge, they would be the largest video distributor above anybody else. So one of the things we're looking for in this sector is how does this video industry evolve, right? Between linear and streaming. And so if you're the largest video provider, you're going to have a seat at that table in being able to work with content providers to make that transition. So I don't think it's just a matter of like satellite being erased to zero, in my opinion. So that's something we're watching out this year. Lastly, I want to bring Mark in on the big tech aspect, because I think you recently wrote a report, a primer on that. So I don't know if you want to throw in something on that.
Yeah, I mean, one of the things about a lot of what we're talking about, particularly with the Netflix, it has kind of a big tech gloss, and a lot of people view this in the context of that. But my colleague Jordan Chalfin, who I think is coming up on the last panel, and he spoke this morning, and I have periodically published reports analyzing the current state of play with respect to all government antitrust enforcement in the big tech space. So that's an area that's tangentially related to what we're talking about, but it does inform the viewpoints of how we analyze a lot of these issues based on the positions they've taken, the things that they've done, and you know, the transitions between administrations with respect to big tech, because it definitely has, I think, an undertone in the way we think about M&A transactions in this space.
Okay. We just have a couple minutes left, so I want to be sure to see if there's any questions from the audience.
For here.
Yes.
I had a question on the next slide. For the bottom chart, do regulators view both of the deals independently, or do they view them as competing for the same company? And then also, how does that, like, how do the two charts, the events of the two charts, so, like, what shareholders decide they prefer, how does that occur on like a timeline relative to like when the regulatory decision?
So the question is, for people who couldn't hear, is about the regulatory timeline. Which deal do they look at, and the timing for, I guess, making a decision? Is that general? Okay.
Yeah, our expectation is that they would only put forward the deal that the company is going to go with. It's not, in other words, it's not, they're not going to look at both and make a decision, and then the company will decide which one's better.
And Hunter, what's the next date? January 8th? Is that?
Yeah, so we have this Paramount has made a tender offer that you have to, I guess, tender your shares by January 8th, but that can be extended, and I think would be extended if they got traction. In terms of the timing, so it's kind of two things. So one, in terms of the regulatory side, like, I think this is something the board and investors are kind of implicitly factoring in when they're saying, hey, are we going to support this deal or not, right? Because you're like, how much money am I getting? But what is the likelihood this gets approved? And then also, what am I left with if this deal is rejected, right? So I think the board has taken that into consideration. I think, I assume that implies that the Warner Brothers Discovery's board is confident that Netflix deal will get regulatory approval. We don't know exactly, what factors have went into that, but I'd say we're more cautious about it than I think. The board is clearly showing that they're confident in, or they would have not recommended it, I think.
All right, we're going to end this one on a fun note. So I'm going to ask each panelist a rapid fire question. Which Warner Brothers trilogy would you take to a desert island? Dark Knight trilogy, Christopher Nolan, Lord of the Rings trilogy, or the Hangover trilogy? I'll start to give you guys a chance to think. I would take the Dark Knight. I think the Hangover's funny, but I think the jokes would get old for perpetuity. And I'm not sure that the second or third movies were that good. So I'll go Dark Knight.
I'll say Lord of the Rings.
Lord of the Rings.
I would do Dark Knight, and I don't even think I saw the third one, because the second one was kind of long, if I remember. But the other ones, I'm just not interested.
All right. Then we'll see what Netflix puts out if they win the company. All right. Thanks everybody for your attention, and we'll have the next panel on trade ideas.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.